that time, all major automobile manufacturers were committing to include HD radio players as a standard in all their vehicles. So we knew it was just a matter of time before that radio player would be a common item in all vehicles. So, and the other benefit that we had with HD radio was that to lease a HD radio frequency, it was about $100,000 a year. So $100,000 versus 20 million, it was a no-brainer for us. And because it was $100,000, we went nuts. We took radio stations in New York, in New Jersey, Chicago, LA, San Jose, and San Francisco. We went national. So now that we had the frequencies and now that we had the coverage, the next step for us was to build the content. So we went over to India. We hired people from Radio City, from Red FM. We tied a deal up with the BBC for exclusive content for North America. And we built this truly world-class content base, which I would even say that not even most Indian radio stations had. So we had the platform and we had the content, so it was just a matter of now waiting till people actually started tuning in, and we just thought, the advertising dollars was just going to flow in. But we were very wrong. The automobile manufacturers who committed to including this radio set as a standard on all their vehicles abandoned the technology. And it was just only a very few brands, very few automobile manufacturers that actually ended up including it. So even though we had the frequencies and even though we had the content, there was very few people who had the ability to tune in. So this was a big problem for us because from an advertiser's point of view, we couldn't really reach out to the 3 million people that we were targeting. So we went back to the drawing board. We re-strategized and we came out and we did something similar to what most other radio stations did at that time. We went online, we launched a mobile app, we registered on iTunes Radio, and we tried to use that digital route to reach the consumer base. But the biggest problem we had with that was none of the advertisers or none of the media or advertising agencies took us seriously as a mainstream radio or broadcasting network. So we had to again go back to the drawing board. And we started thinking, okay, what we really have is a really good content base. It's just a matter of getting this out to the people. So what we came across was there was a lot of what we call mom and pop radio stations. These are like guys in certain cities who would rent a couple of hours of the day from another radio station. So like say they would rent 3 p.m. to 7 p.m. and play Indian radio. And then the rest of the day, it would be like a Korean station or another multinational station. So we went out and reached out to all these guys and we said, hey, we'll give you world-class content. You guys manage your radio station. You guys get the advertising dollars. You just pay us a fee for using our content. And that was a very successful model. Pretty much almost every radio station in North America focusing on the Indian market ended up playing our content, which was a major win for us. But we also realized that if we want scale, we cannot, using this model, we can't just be focusing on the Indian market. We need to be going after all multinationals or all minorities. The Japanese, the Koreans, the Vietnamese, or even the Chinese. So while we were on that pathway was when we got to know that ESPN was tendering the rights or auctioning the rights to broadcast the FIFA World Cup live on radio in every language but English, because English they wanted to broadcast it themselves. So we knew this was the perfect platform for us to be taken seriously as a multinational, multi-language media player, media content company. So I remember going to the ESPN office during the tender day or the auction day, and someone told us that the cost of this license would probably be around $1.5 million. And we probably had about 10% of that in our bank account. So we had to be creative, right? I mean, it's two Sri Lankans, we're pretty good at talking, so we managed to convince them that we had the money. So we went in, we bid, we probably overbid it because, we had to compensate ourselves. So we went in and we actually won the license, which was a really good thing, but now we had to come up with the money. And it's not an amount that you can just go to your father and ask for either, right? So what we did was we told ESPN, yes, this is ours, we are going to take it. we then went to other media companies, other radio stations, the Chinese, the Koreans, the Vietnamese, and we said, hey, we have this license. Do you want to have exclusive rights in your language? And we sold them the exclusive rights. And using the deposit money from those guys, we ended up paying ESPN. And we got that license, and we quickly gave them the feed, and we ended up making over $4 million from that deal. So it was a deal which was worth $1.5 million. We didn't have the money to do it. We were pretty creative, and we planned it, executed it, and it was one of the best deals that company did at that time. So what I really learned during my time at World Band Media is 95% of the businesses, I mean, you guys probably know this, but 95% of the businesses that start up each year fail. And from the 5% that actually survive, I would say even 99% of them don't turn out the way that they really intended to on their business plan. And I think that's completely fine. What's really important is that you keep reinventing yourselves every time you get shot down. You've got to be creative and not take no for an answer. And that's exactly what we did at World Band Media. And just so you guys know, now World Band Media we went from being an Indian radio station to a content company to a multi-language media company. And now it's actually a Hispanic radio talk show station on Sirius XM. How would we have ever imagined that we would have been from Indian to speak in Spanish? No chance, right? But we did it. And my partner is still running that firm, and it's doing quite well still. So the second venture I want to talk to you about is about this small logistics company called California Logistics, or CLL. So after moving back to Sri Lanka, like Saurashi said, my father asked me if I would be interested in getting involved in some of the family businesses. So one was this. So CLL was your typical third-party 3PL, third-party logistics firm. They were doing freight forwarding, clearing, transport, a very saturated business, a very saturated segment with very, very low margins. So when I got involved, I used to always think, when I was living in North America, I used to always see these massive car trailers going on the highways there, carrying 10, 15 cars at a time. And I used to always wonder why Sri Lanka never had any of them. And then when I started getting involved and I wanted to really diversify our portfolio, I dug into this, I researched into this. And I saw that it was mainly because all the vehicles that was coming in at that time was coming to the Colombo port. And all the importers were mainly around Colombo. So all these guys had about 30 to 40 drivers who would go to the port when a shipment came, drive to the yard, and then send the drivers back again. And their biggest problem was vehicles going missing during these clearing times. So one day I remember waking up and reading the news, and for our luck, and probably for the whole country's bad luck, they were opening the Hambantota port, right? And the port was without any cranes. So the only things that could get unloaded in that particular port were things that could literally drive off the ship, right? So immediately the government said they're going to move all the vehicle imports from Colombo port to Hambantota port. And because we had done that research, and because we've seen these trailers in the road before, we knew immediately that existing models of using drivers to bring each individual car by road is not going to work. So we immediately jumped on it. I remember writing to a couple of the trailer manufacturing companies in Europe, in China. I went on Alibaba and tried to see how we can import a trailer down. But it wasn't as easy as we thought it was, because none of them were willing to ship it assembled. They all wanted to disassemble it and then get it assembled, dismantle it and get it assembled here in Colombo, which can always be tricky. So what we did was we got the engineering drawings from one of the firms, and we partnered with a local firm here called Tantri and got it fabricated ourselves. And because we did our research, and because of our past experiences of knowing that things never go according to plan, we were actually a little smarter than the rest. Because we built our trailer in a way that it had the flexibility to carry almost any type of vehicle. It could carry from a bike to a three-wheeler to a car, a jeep, like a SUV, a van, and even a bus. So we knew that in case there's a downturn in automobiles, we could always transport some other form of vehicles which had a constant demand, like three-wheelers. We were the first to actually have a vehicle trailer being used here in Sri Lanka. So we had 100% of the market share. And then, of course, eventually other people caught on and they started copying. But even when they started copying, because of the head start we had, we were able to move up the value chain before they were able to think about it. We went from just transporting it, we went to clearing the vehicle, transporting it, bringing it to our yard in Colombo. We would do light assembly. That's like fixing the side mirrors, putting the carpeting in, and other small modifications. And then also monitor the stock levels of, say, for example, AMW or something, and see which of their outlets would have a lower stock. And then based on the sales, we would replenish those. So we were able to do that while the other guys were still trying to figure out how to bring vehicles from Hambantota to Colombo. And that really helped us to integrate ourselves into the supply chain or the logistics chain of those companies. And because of that, we still command 70% of Sri Lanka's automobile transportation market. And Sri Lanka imports almost 6,000 vehicles each year. So that's a pretty good feat to have. And because of that, it really put CLL onto a platform. And just over 5 years, we moved from being an 80 million rupee company to doing over 1 billion right now. And so if you ask me what my learning from CLL was, it was really jumping on an opportunity and connecting the dots. And don't be scared to make that decision. Because if you plan it out, and if you plan it out properly and with seamless execution, the chances of you going wrong is actually very, very minimal. The third venture, which I would say I'm still very much involved in, is the apparel venture, which was Foundation Garments. So after two pretty successful ventures with the media company and the logistics stint, I thought, you know what, maybe it's time for me to get involved in apparel. I mean, how hard could it be, right? And then I found out pretty soon that it's bloody hard. So I got into Foundation Garments. So Foundation Garments before was called Jinadasa Garments. It was formed about 35 years ago, and like Swarish said, it was started by my father. And just like most other apparel companies in Sri Lanka at that time, it was a very family-driven, family-owned business. It was a very family-driven, family-owned business. So it was owner-run, it was owner-managed, and the success and failures of those companies are very much directly related to the owner who's managing it at that time. So, which was my father. So my father put in a lot of hard work and time and dedication towards this, and he grew that business from zero to almost $40 million, growing it from one factory to 12 factories in Sri Lanka. He had factories in Ghana and he had factories in Kenya. But 25 years into the business, you get tired, and you start becoming content. You know, you're happy with what the business is making, and that's when it becomes dangerous for companies, because you stop reinvesting into your business and you start investing into other, I would say, headache-free businesses. And most often it was land or real estate that people went into. So what people don't realize is when you stop reinvesting in your business or when you stop changing the game, everybody else is continuously running. And you need to keep running to stay in one place. So the day you stop running, you actually start falling back. So what happened here is 2008 came, my father turned 50 and he retired. He thought, you know what, this is it. I've gone through enough pain. I can live comfortably from what I've earned so far. So he gave the company to be run by a bunch of managers who somehow managed to bring the company from a $40 million to just $6 million in 4 years' time. And we went from 12 factories to 4 factories, with all the foreign factories also closing over the space of 2 years. And that's the time I really got involved. So because of my learnings from previous couple of businesses, what I first tried to do was I tried to understand the apparel business. I mean, 5 years in, I'm still trying to understand the apparel business, but I have a bit better idea now. But so I got in, and when I studied the other players, the top 3 guys, and saw what they were doing different, and what I immediately realized was that we were lacking the management which these guys had. And that was a real catch-22 position for me, because Foundation Garments, or Jinadasa Garments at that time didn't have the best name because everybody knew it was shrinking. And we were too small to either attract or afford good management. So again, we had to be creative. So what did we do? We broke down the business into 2. We broke it into manufacturing and we broke it into trading. We had the 4 factories, so we actually franchised out the 4 factories that we have, and we gave it to 4 management companies to manage the factories on our behalf. We told them, you run the factories, you execute it, whatever capacity you produce, I will buy at a fixed price. So that really solved my manufacturing back end. And that limited me to just focusing on the front end. And by leading from the front and then also getting help as we grew with professional management, we managed to really develop a pretty good front end. And just over time, we managed to grow it from $6 million to nearly $50 million within the space of 4 years. So we actually became bigger than we ever was just last year. So what happened thereafter was, one thing which I truly believe in is, as important as a business strategy for a businessman, it's also very important to have an exit strategy. And my exit strategy for apparel or for Foundation Garments was, I need to grow this business till it reaches $100 million. And that gives me scalability. And once I reach that scale, I'm going to look at an exit strategy like either a merger or a takeover or even a public listing. So now that I knew that I was halfway down the journey, I wanted to get a second opinion. So I thought no better way to get a second opinion than to reach out to the investment banks or the private equity funds. So I reached out to them with no intention to dilute my stake or dilute our family's stake. I just wanted to see and get feedback of what potential investors thought of our business. So I met them. Some were quite interested to invest in it, some weren't. But the feedback that I got was quite priceless, because I now got the thinking of a potential investor. And I managed to tweak the business to suit the needs of a potential investor. We brought the corporate governance in, we started to structure it a little bit, and things like that. But what really happened from that whole exercise was that a couple of months after, I get a call from one of those investment banks, and they call me and say, Dilanka, there is a British company who's keen to look at a merger. Would you be keen? So, I mean, I really wasn't, because I was still at $50 million, and I knew if I gave away a considerable stake right now, I'll be diluting my ownership too early, and I'll be losing out on shareholder wealth. So, but I thought, you know what, it always never hurts to learn. So I went for that meeting, and I still remember it was at one of the auditors' offices, and I walked in, and there sits Dan Gomez. So I got a shock. I was like, okay, what's this guy doing in a so-called British firm? I was like, okay, is he advising, or is it MAS pretending to be a British firm? I was actually so confused, and I sat down, and then Dan starts talking, and he goes, look, I'm retiring from MAS, I'm starting a new venture, I'm getting involved in a new venture called Hela. This is what I'm going to do for Hela, this is what we're going to do in 5 years' time, this is what I want you to do, and this is how you fit into the organization. And he was giving that whole story, and that entire time I was trying my best not to smile and give it all away. So those are the three stories which I wanted to share with you. I mean, those are some of the stories that I have gone through in my short career as a businessman, so to say. And those are experiences which has really changed me. And what I really value from those experiences is that every business I had a learning, good and bad. And it's always executing that learning into the next business that really helped me to avoid the same mistakes which I made previously. And one thing which I want to always tell you guys is, even if you're not a entrepreneur or be self-employed, even if you're an employee, what's really important is to come to work every day and keep reinventing yourself, keep reinventing your business, even if your business is doing well, because that's the only way that we can survive, by doing better than yesterday. Right. Thank you very much.